Good afternoon. Jeremiah Conjure here from Annuity Association, and we are back yet again for another unbiased annuity review for fixed indexed annuities. Today we're going to be talking about a unique product offering from North American company. They are part of Salmon's Financial Group, and the product is their number one selling fixed indexed annuity. It's called the VersaChoice 10. And we'll go ahead and dive into the brochure to discuss some of the great features and benefits this annuity offers today. Bear with me, I'm going to share my screen here. Before we do that, actually, let me go ahead and do the fun part of this review, and that is the great disclaimer. So let me go ahead and share my screen. Okay, this is a review, not a recommendation to buy or sell an annuity. North American company has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. All right, that's the best part. Just kidding. So today we're talking about the VersaChoice 10. Again, this has been the number one selling fixed indexed annuity offered by North American company. They are a subsidiary of the Salmon's Financial Group, which also owns Midland National Insurance Company, so they're sister companies, but this is their flagship product. And once we dive into the features and benefits, it'll be very clear on why this is a unique product and why it has been the number one selling fixed indexed annuity from North American since they've launched it. Now, overall, this particular product, the last for third quarter, according to all fixed indexed annuity sales on the independent marketplace, this was ranked number 4. So it's in the top 10. Very awesome features in this annuity make it a unique value proposition to most pre-retirees and retirees. And overall, Salmon's Financial Group, both housing Midland National and North American company, they are currently ranked as of quarter 3 sales. At the end of quarter 3, they were ranked at number 3 on the independent marketplace for fixed indexed annuity sales overall. Now, the particular product is called VersaChoice, and the real key word here is that product name, VersaChoice. Versa, where they're basically trying to identify with the word versatility. This is a very unique product in the sense that it offers some unique features and benefits that allow versatility to occur in the event of a life event which would require you to maybe go a different direction than you initially intended when buying an annuity. So North American took a view holistically of their target demographic, which are pre-retirees and retirees, usually age 55 to say 75. And they understand what's most important to them, and they built this product centered around key focus areas based on those areas of importance. So this product offers enhanced liquidity for whatever the future holds. So not knowing exactly what's around the corner, knowing that you have some peace of mind and flexibility inside this annuity from the enhanced liquidity feature gives you that peace of mind, knowing that long term, in the event something's change, you have some options to be able to pivot and go a different direction. So diving into the brochure, we're going to really talk about what separates the VersaChoice 10 from the other fixed indexed annuities on the market. The one key thing that we're going to be talking about and spending some time on is the key optional rider that they do charge a fee for, but it allows you to take advantage of these really unique features and benefits that will give you added peace of mind if you decide to invest in a fixed indexed annuity. So we'll be talking about those features. Let's go ahead and dive into them. So some of the key benefits of that, of the VersaChoice 10, are there multiple options for liquidity. When you choose the optional Enhanced Liquidity Benefit Rider, you'll have several ways to access more of the funds earlier should the need arise. You'll also have the ability to choose a growth strategy that suits you best. There's multiple different index strategies offered in the VersaChoice. Some of them are very, very competitive from a participation rate perspective, and we'll dive into those rates and give you an idea of what they can potentially do for you from a growth perspective. We'll also take a look at the individual indices themselves so that you can see how they're performing year to date, as well as some back historical testing. And we'll look at, really what separates this annuity apart, and that's those liquidity features. As with any fixed indexed annuity, tax deferral is an added perk. So if you go into this fixed indexed annuity, maybe you're looking for a safe alternative investment that would, compete above and beyond the traditional bank certificate of deposit, money market, or bonds, with interest rates at all-time lows. Retirees and people, that are looking for safe interest, they're really, having a hard time finding the right product for them. And, the VersaChoice should be one to consider just based on the added growth opportunity, but also the liquidity features that are there. And in addition to that, we'll talk about the legacy benefits that are available in this annuity as well. So the VersaChoice gives the investor also a great way to provide a lasting legacy. Your beneficiaries can get the remaining accumulation value of your annuity as a death benefit. So since it is offered as from an insurance company, there is a death benefit that is paid out, which is the same amount or equal amount of the total accumulation value. And that can be paid out in one of two ways. You can take an immediate lump sum, so whatever that death benefit value is at the time of death, the beneficiaries listed on the contract would receive the full benefit amount, which is equal to the accumulation value. And in addition, your beneficiaries will also have the option, if they would prefer to maybe get a little bit higher payout over a period of time, they can elect to take installments, which would give them the opportunity to take a higher amount over a period of 5 years. And we'll talk about the specifics of the enhanced death benefit offering in this annuity momentarily. But the key here with that benefit is it does avoid probate. So it doesn't, require your loved ones to go through any costly probate processes to be able to access these funds. This goes immediately to your beneficiaries as long as they provide a death certificate. And then when it comes to flexible payout options, the VersaChoice has you covered, whether you need to start drawing income soon after purchasing your annuity, or you prefer to wait and build your lifetime income potential. There's an option for each one. So for those not familiar with North American, they are an A+ rated company, which is considered a superior rating by AM Best. So they are a very, very financially stable organization. Multi-billion dollars are managed by North American. Okay, so here's the bread and butter. Here are the meat and potatoes, the enhanced liquidity benefit and how it works. So through 4 unique features, the optional Enhanced Liquidity Benefit Rider for a fee offers you the versatility you may need to navigate whatever life has in store. You'll pay an annual fee equivalent of 60 basis points of your total accumulation value on an annual basis. So let's dive into those features. So number one, first and foremost, are the enhanced penalty-free withdrawals. So in the standard version without the optional rider, the investor can access up to 10% of the accumulation value after the first year with no penalty from surrender charges incurred. However, if you're looking for more peace of mind or more opportunity to withdraw more than 10% that's included, the Enhanced Liquidity Benefit Rider will allow you to take up to 20% of your beginning accumulation value penalty-free if no other withdrawals have been made the previous year. So, for example, after the first year and after the second year, let's say you haven't taken any withdrawals, and that third year comes, and maybe you're wanting to take a trip or knock something off your bucket list, and you want to withdraw some money from your accumulation value. If you have the enhanced liquidity benefit rider, you could take up to 20% of that total accumulation value with no penalty, no questions asked. Option number 2 is the return of premium. So this is a very unique feature, really separates it apart from many of its competitors. This is just peace of mind. In the event that life changes or your retirement planning strategy changes moving forward, if you have the enhanced liquidity benefit rider on your annuity with the versachoice, anytime after the third contract year, you may terminate the contract and receive no less than your contract's net premium paid less any strategy charges. Strategy charges are the enhanced participation rate charges or the rider charges for the enhanced liquidity benefit. The net premium is equal to the total premium reduced by all withdrawals on a dollar for dollar basis. So if you haven't taken any withdrawals, any of that 10 or 20% withdrawals that are offered in the enhanced liquidity benefit rider, then if you decide after the third contract year that you'd like to move a different direction and get all of your money back, you'll have the peace of mind knowing that you can do just that. So there's further flexibility when you may need it most, and this is very important. I think that one of the most overlooked areas of retirement planning is planning for long-term care. There's a statistic, that's going around offered by a lot of research database companies that specialize in long-term care, and they have determined that of someone age 65 today, there's a 70% chance that they'll need some form of long-term care in their lifetime. If you haven't done any research on long-term care, it's a very costly matter. It's very emotionally draining to your loved ones, especially if there's no funds to pay for it. And it can really erode your retirement nest egg and your legacy benefit if you're planning to leave, a bequest to your loved ones. So one of those things was, considered when they put this product at North American together was, hey, we need to offer our potential clients a way to pay for long-term care in the event that arises. And so they've done just that. And what they call this is the ADL-based surrender charge waiver and the ADL-based payout benefits. So number 3 is that surrender charge waiver. If you're unable to complete 2 of the 6 activities of daily living, those are things like walking, feeding yourself, bathing, continence, all of those types of things. If you can't perform 2 out of the 6 activities of daily living, after the issue date, you'll qualify for up to 100% of your accumulation value to be withdrawn and made available immediately, and no surrender charges or market value adjustments will be applied. So again, if you have a need for long-term care or any type of confined care, specialized care, as long as you meet that requirement of not being able to perform 2 out of the 6 activities of daily living, you could access 100% of your accumulation value and withdraw it all without incurring any penalties if you find yourself still within that 10-year surrender period. And then the last benefit is also relating to the activities of daily living. If you're unable to perform 2 out of the 6 ADLs, so again, that's the trigger or the qualifying event, after your second contract anniversary and otherwise qualify, you may choose to draw an income over 5 years that is based on an enhanced accumulation value amount. And the percentage will vary by contract year, and there's a chart below that we'll cover. This accumulation value multiplier increases the longer you keep the funds in the annuity, maxing out after 6 years. So basically, the way this works, it's very simple. It's not complex at all, honestly. After the first 2 contract years, if you can't perform 2 out of the 6 activities of daily living, you have two options. You can either take the lump sum of your, accumulation value with no penalties, or you can elect to take a period of payments, so that can over 5 years. And what they'll do is, if you decide to take the payments over that period of 5 years, they're basically giving you a bonus on top of your accumulation value for doing so. So contract years 3, if let's say year 3, you happen to qualify for this activities of daily living event, then rather than 100%, they'd pay 110% of the accumulation value paid out over 5 years. Year 4, if you had a need for it and you decided to go this route, it'd be 115% of your total accumulation value paid out over 5 years. Year 5, 120%, and year 6 or above, 125% of your accumulation value paid out over 5 years. So you're basically getting a bonus. This might be a smart route to take versus taking all of the lump sum, because your cost of care is going to be an annual figure anyhow. And, you might, if you have other funds to supplement this strategy, why not take the bonus money to make it, last a little longer or go a little further? I think that's a smart and sound option to consider. So we talked about the activities of daily living. Again, those are bathing, continence, dressing, eating, toileting, and transferring. So if you can't perform 2 out of those 6, you would qualify for those enhanced benefits. Okay, so on the growth side of this annuity, there's a lot of attractive options, a lot of index strategies that are found in this annuity, very competitive from a participation rate perspective. And, honestly, while this is an unbiased review on this product, one of the index strategies, actually 2 of them that are found in here, we're actually pretty big advocates for, just because of the amount of analysis that we've done in researching all of the available index strategies on the independent marketplace. 2 of them found in this annuity are very strong players, and looking at our research, we're very confident in the way that they perform. So there's plenty of options when it comes to crediting interest. They have monthly point-to-points with caps. They have annual point-to-points with caps, annual point-to-point with margins, participation rates, and then they also have annual point-to-point with enhanced participation rates. Now, those enhanced participation rates are offered only if you elect to add the enhanced participation rider. So we'll talk about that momentarily. And as with any fixed indexed annuity, you have a guarantee of a 0% floor in the event of an underperforming index for your particular period of time, whether it be a 1-year or 2-year point-to-point strategy. You're guaranteed a 0% floor, knowing that you can never lose a dollar in the event these index do not perform in a positive light. Wide range of index options. We have the standard S&P traditional index. We have the S&P multi-asset risk-controlled index. That's one of the indexes that we're pretty fond of. There's the Fidelity multi-factor yield index and the S&P 500 low volatility risk control index. Now, you do have the option to transfer in and out of these index options every anniversary period. So if you sign up for a 2-year strategy, every 2 years you can reevaluate your index strategy, and if you're comfortable with where it is and how it's performed and how it may project moving forward, you can leave your money there, or you can move out and switch. So if you're in the Fidelity multi-factor for the first 2 years and you want to try out the S&P 500 index, you could do that. If you want to allocate 50% of your funds to the Fidelity multi-factor and 50% to the S&P Mark V, you can do that. You can diversify inside the fixed indexed annuities, and that's really one of the sweet spots that I think is underutilized, is knowing that you can really set up your own diversification within the annuity while also having a guaranteed 0% floor. So that's ideal for folks out there that are risk adverse. They're not wanting to take, stock market risk head on, and they're wanting the benefits of the safety and protection that a fixed indexed annuity offers with the guarantee of 0% floor or a guarantee of principal protection, this is a great solution for you. Not to mention one thing that I think we overlooked, or maybe it hasn't come up yet, but they have a solid fixed account in this annuity as well. At the current time of this review, the interest rates are 1.15% on the fixed, 1.5% on the fixed account. So better than most CDs out there. There's actually a high band and low band. The low band is under $75,000 investment. It's 1.15%. And then if it's $75,000 investment or above, it's 1.5%. All right, so we've talked about all of the options here in terms of the features and benefits. We really spent a lot of time on that enhanced liquidity benefit rider. We also spent some time on the index options. And one last thing we'll cover, since it's in the brochure, is the surrender charge schedule. So this is a 10-year surrender period product, or surrender charged product. 10 years is the contract term. So in the event you exited early within that 10-year period, there would be a penalty that would be incurred on the dollars withdrawn at that time. So the fee starts at 10% for the first 2 years and then works its way down each year thereafter, or every 2 years after, and ending at 2% year 10. What we're going to do now is, there's a lot of different options from a crediting perspective on the indexes that are available in this annuity. So one of the values that we provide our prospective clients here at Annuity Association is, helping clients understand and identify the top crediting method and index that's available to them. And we can look at back-tested performance to see how they've performed over the last 10 and 15 and sometimes even 20-year periods to give us some perspective on, how they can potentially perform moving forward. Now, prior performance does not indicate future performance, but it still gives us some added clarity to just get an idea of what we could possibly anticipate. So if you notice, looking at all of these index options, there's 1, 2, 3, 4, 5, 6, 7 different crediting methods, and then 4 different index crediting indexes. 4 different indexes themselves. So you've got a lot of options there, a lot of ways to diversify too. And I think when it comes down to understanding annuities and fixed indexed annuities, they're not very difficult to comprehend once you understand the intended purpose behind them. If you're looking for safety and growth, or safety and lifetime income, that's what a fixed indexed annuity is designed for. Or if you're looking for legacy, that's another added benefit. And understanding that is very simple. Really, the difficult part is finding the best annuity for you, finding the best one available on the market that's going to meet your individual needs, and that's where we come in. So if you're interested in maybe comparing an annuity that you currently own or that you're potentially weighing versus another one, we'd be happy to help you with that comparison. We'll take you to the independent marketplace and bring them all to you to help you make an educated decision. To do that, just go to annuityassociation.com, and we'll be more than happy to help you out once you fill out that request for the free report. Okay, so let's go in and take a look at these crediting methods to figure out, really which one's going to offer us the highest benefit. So bear with me while I pull up our software here. This is the software we use to compare all of the independent fixed indexed annuities on the market today. Okay, it's coming up. Here we are. All right, so what we're looking at here is the hypothetical historical performance over the last 10, 15, and 20-year periods. So you'll see they're listed in chronological order according to highest growth to lowest growth. And the top option that we're seeing right now is the 2-year Fidelity multi-factor yield 5% index with the point-to-point and enhanced participation rate rider included. That rider fee is 1.5% to have the enhanced participation. So where you need to really weigh the option is the fee worth it? Looking back, our research shows that it is. But maybe you're one of those investors that would like to keep things simple, or maybe you're just not feeling comfortable about necessarily having a fee. If that's the case, you can go and elect to have the option that will not charge a fee, and we'll look at that and see what the growth is. We can actually filter it out, but first let's look at the performance of the feed version, and then we'll take a look at the non-feed version. So here is the 10-year, 15, and 20-year performance. If you look to the right here, the 10-year average annual credited interest looking back from December 31st of 2009 to December 31st of 2019, the average annual credited interest is 10.71%. Very, very competitive. It's almost market-like. Now, I'll be the first one to tell you that these fixed indexed annuities are not designed to outperform the stock market, plain and simple. What they are designed for is to allow the investor to have the peace of mind that their principal is protected from market loss while giving upside participation potential based on market index performance. So your money's not actually invested in the market or the specific index that you're assigned to. All that index strategy is used for is to determine how to pay you your interest if there has been any earned. So in this particular case, the last 10 years, 10.71%, that's incredible. But we all know that, the last 10 years we've been on a long bull run. And, everybody's made money in the stock market the last 10 years. So, but what it does do is it lets you know, hey, I would not have had to take the risk associated with getting a 10% return from the stock market. You wouldn't have had to take that risk of the potential loss that also comes with, that reward. So, the stock market is a risk-reward relationship. In order to get the reward or a higher reward, you have to take higher risk. And the fixed indexed annuity allows you to still get reasonable rates of return with zero risk to the downside. Very, very important to understand that. Now, these red and green numbers down below this, you'll notice the 11.25 is the best 10-year period over the last 15 years. And then the red number is the worst 10-year period over the last 20 years. So you'll see that data point is January 30th of 1999 to January 30th of 2009. Now, that's a very important data set here, and here's why. Dating back to 99, that was just about a year or so, year to 2 years, right before the dot-com bubble bust. So that entire decade, 99 to 2009 or 2000 to 2010 is what's known as the lost decade. Many people that were invested in the stock market did not make any money for those 10 years because of the dot-com bust and the global financial crisis in 2008. So to know that even through the worst, that's really telling. The worst 10 years that this country may have possibly ever gone through from an economic perspective outside of the Great Depression, to earn 3.83% during those difficult times while having zero risk to the downside, that really tells an important story. I think that should give an investor a lot of confidence of what these can potentially do. And I'm not even talking about growth-wise. I'm talking about protection-wise, and still being able to gain some interest during very difficult and challenging times while everyone else not in these types of products may be experiencing a deficit or a loss. Okay, over the 15 years from December 31st of 04 to 2019, 6.96%, and over the last 20 years, December 31st of 99 to 2019, 8.12%. So very, very solid performance there. Really impressed with this product, and that all stems from the enhanced participation rate that you're finding for that 1.5% fee. Another way to weigh that fee out, if you're kind of on the fence about it, is, if you were to go have your money managed with a financial advisor or broker, they're going to charge you anywhere from 1% to 2%, depending on how large of the sum of money is that they're managing. So, for this 1.5%, you're getting something that no broker, no financial advisor can do, and that's a guarantee that you can't lose money. That's what the fixed indexed annuity does, and that's the value and the peace of mind that's offered. So for the 1.5% fee, you're getting a guarantee that you can't lose $1 on your money due to market losses. That is a really impactful. The second strategy below this, so you'll notice what these are here. There is a high band and a low band offering. For investors looking to put $75,000 or above, you'll get a higher participation rate for that 1.5% fee. It's a 165% participation rate. For those not familiar with participation rates, what that means is of the market performance or the market index performance, your contract or your accumulation value would grow 165% of whatever the index performance was for that period. So for example, if the index went up 10%, your accumulation value would be credited 16.5% after factoring in the 165% participation rate. All that means is of the performance, how much of it do you participate in? And in this case, it's above and beyond the actual performance. So very competitive rate there. If you're investing $75,000 or less, or $74,999 or less, the participation rate drops to 140% instead of 165%. But if we look, the numbers are still very competitive. 9.17% over the last 10 years average annual credited interest, 9.64 on the best 10-year, 3.29 on the worst 10-year, and then 5.96 over the last 15, 6.95 over the last 20. And the third best option is the 1-year point-to-point with the Fidelity multi-factor index. It's still charging that fee of 1.5. And then the S&P Mark V comes in as well. Now let's look at the non-feed version index crediting methods and options available in this VersaChoice 10. So if you're not wanting to pay the 1.5% fee, rest assured you can still access this product and get all of the features and benefits that we've highlighted to this point. And if you want that enhanced liquidity benefit rider, you can still add that on at 60 basis points. Now, the difference here is that the same index and point-to-point strategies are available. The difference is that they're dropping the participation rate from 165% to 80% on that Fidelity multi-factor index. So you'll see what it does. It really does make a difference on the potential growth from this strategy. So you'll see over the last 10 years, 5.36% average annual credited interest, 5.65 on the high 10-year, and 1.94 over the worst 10-year period, 3.49 over the last 15, and 4.05 over the last 20. So, it's really telling right there in those numbers that if you're looking at the highest growth opportunity the enhanced participation rider is worth the 1.5%, as long as we get anywhere close to the historical performance and how the market's unfolded. We still know either way, apples for apples, the enhanced opportunity is going to provide a higher economic benefit than not having it. The fee is justified is basically what I'm trying to explain. Okay, so we've covered all of that. The indexes, if it was me looking at this product to invest, I'd either go with that Fidelity multi-factor index or the S&P Mark V with the enhanced participation rider. And here's why. So one of the things we also do is an in-depth analysis of the specific indexes that are offered in all of the fixed indexed annuities across the independent marketplace. And we can see year-to-date performance and how they're doing to help us make an educated decision on whether they're right or not to consider. So I like the Mark V. It's one of my, I'm a fan of this one. Now, I know this is an unbiased review, but I also work in the business, so I have to be clear on which ones I feel are very appropriate for most situations. And the S&P Mark V is very competitive, and the reason being is the way that the index is structured. It's a multi-asset, risk-controlled index. It basically has the ability to rebalance itself on a day-to-day basis and sometimes even by the hour based on certain triggers that are structured in the index and algorithm itself. So when it gets tripped by a 5% volatility level, it reshifts all of the assets in the index to non-correlated assets to that particular level of volatility. And so what it does is it makes up a real-time decision to shift the assets of the index to allow it to benefit from the upside of the adverse asset classes found in the index. So if stocks are having a very volatile period or very volatile day, it'll shift some to fixed income or shift all of it to fixed income. If it's having a high inflationary period, it'll shift it to commodities or gold. And so it has the ability to be very dynamic on a daily basis. And what that does for you as an investor is it gives you the peace of mind knowing that even in very volatile markets like we just had earlier this year, this particular index can still make money. Whereas if you had a directly correlated index like the S&P 500, well, while the S&P 500 index is down, just like it was back in March, if you were 100% allocated to this S&P 500 index and this annuity, you'd be down in that as well. And the S&P 500 is not a daily rebalanced index, so it does not have the ability to learn like an algorithm learns and be able to perform at a higher level during volatile periods. So one thing I'd like to do real quick is pull up one of the reports that we put together that basically helps us understand markets and the indexes and how they perform. And one of the things we did back in March was we looked at all of the indexes that were available in these fixed indexed annuities to see how they were really performing during some of the most recent volatile periods in our economic history. So back in March 2020, with the coronavirus coming out and a lot of states and companies and things and industries shutting down, the markets took a tumble. Most were down 20 to 25%. And at that time is when I dove into this report and I said, we really need to identify the indexes that are still positive, or maybe, even if they're down 1% or 2%, they're still not down 20 or 25%. That's a big difference. So the first thing I did was I went through this report that we had put together and I identified all of the indexes that were positive. They were still above zero. They were not in negative territory. And I'm not going to spend a lot of time on this, but I want to point out the S&P Mark V. That was really what won me over on this index. So for some reason, I can't highlight this with my mouse, but the S&P Mark V back in March was still at 2.46% positive. So that's very telling that even through very volatile periods, the index works as designed. The S&P 500 total return index, at this same time that the report was pulled, was down 8.27%. So the S&P Mark V, with the volatility controls that it's built with, was up 2.46. You'll notice everything else is really it's all negative. So that was the first thing I did. There was about a dozen indexes that I found that were less than 1% down. Most of them were still positive. And I'd be happy to show those to you if you're ever interested. Just go to our website and book a meeting. We'll talk about it. Okay, so we've talked about the indexes. Let's see if we can find the Fidelity multi-factor index on here. Okay, here it is. So it's up as of December, about a week ago, 4.23%. Last year, 2019, it did 11.78%. 2018 was down 53 basis points. The last 1 year, 4.42%. Last 5 years, 5.82%. Last 10 years, 5.92%. And since inception, 4.97%. On the S&P 500 mark, let's go back to that one and take a look at its overall performance in the same time frames. Here it is. So it's at 7.61% year to date, 13.7% last year, 3.3% down 2018. The 1 year average return, 8.7. Last 5 years, 6.38. Last 10 years, 4.95. And the last, since inception, 6.36%. So very good numbers there. That is not factoring in any of the participation cap or spread rates. This is the true performance of the index itself. All right, so we've looked at the features and benefits. We've talked about the index crediting strategies. We've talked about the indexes themselves. The only thing, let's see if I can do this with this particular product in here real quick. See if I can run an actual illustration. I may not be able to on this one. Let's see. Oh, no, I can. Okay, cool. So we're going to take a look at a male in the state of Florida at age 64, putting in $100,000 of non-qualified money, meaning it's after-tax dollars. You are also able to roll over 401ks or any type of qualified account to this annuity as well, and it can have the same tax deferral benefits as well as the required minimum distribution management when you turn age 72. All of that stuff can be managed in the annuity. So here, what we're doing here on this screen is looking at all of the different indexes and crediting methods available in the VersaChoice 10. And then what the software is doing is looking at all of those back-tested 10-year periods and determining which one would give us the highest growth opportunity. Obviously, as we previously stated, the enhanced participation rider is going to offer the highest growth opportunity when looking back over the last 10 years. And so it's showing at 10.71% average return for that Fidelity multi-factor. Now, here's the other thing that this is doing. It's also diversifying and putting different percentages in each crediting method and index to determine, if there would be a higher economic value that way. You'll even see down here like this 7.12% to the right. It's putting 25% of that 100,000, so 25,000 in 4 different strategies. So very cool there. But let's just look at the highest one. Let's go ahead and offer add the enhanced liquidity benefit rider to the annuity as well for the 60 basis point fee and generate the report. All righty. So here we're showing 165% participation rate, 1.5% fee on that option for the enhancement on the participation, and then the 2-year point-to-point Fidelity multi-factor index. As with any annuity, when you buy an annuity, you buy a contract that offers a guarantee. In this particular fixed indexed annuity, the guarantee is on principal protection. You have a 0% floor. So this is just showing that guarantee of 0%, meaning the index did not perform whatsoever over the entire duration of this contract. What would it look like? Well, it's factoring in the fees. So we're getting charged that 1.5% fee on the 100,000 for the enhanced participation rider. And you'll see that the green column, the accumulation value, does start to deteriorate over that period. But this is assuming 0% return every single year. Now, let me just illustrate something for you. If you're not familiar, there's only been one time over the last, close to 100 years since the inception of the S&P 500 that the index had a negative loss for more than 3 years. And it was just once, and it was 2000 to 2002. So 2000, 01, and 02, the S&P 500 returned a negative performance. And that's the only time in history that that's happened for more than 3 years. So not likely to happen, but this is the guarantee that you get, that you have principal protection. So you're getting a goose egg for non-performance. Now, here's the hypothetical values using the most recent 10-year calendar period, using that 2-year point-to-point strategy in the Fidelity multi-factor. We still have our red column showing the fees being charged. And then we have our interest rate. You'll see every 2 years, because of it being a 2-year strategy, the second contract year, it's showing a 38.31%, and then 0, and then 19.74%, and then a 0, then year 6, 13.52. You'll see the interest that's being credited here in the interest credited column. You'll see the fees being charged against the total accumulation value. So you'll see the fees go up when the accumulation value grows. That's the 1.5% being charged on the total accumulation value for each annual year. And then you'll see the green column. So after 10 years, which is the surrender period, is if the markets perform the way they did the last 10 years, your 100,000 could grow to $237,786. Very, very, reasonable rate of return. Granted, the last 10 years, everybody's made money in the market. The key difference here is that you're getting a guarantee that your money is safe and protected. This is looking at the most recent 10 years, highest 10 years, and lowest 10 years. You'll see on this particular product, the low period is that 2000 to 2009, 3.83%. And the high period is 2010 to 2019, June 20th, 11.25. And the most recent 10-year period, December 31st to 2010 to December 31st of 2019, 10.71. Very strong performing product. This is a pure accumulation focused annuity with options for liquidity. So this annuity really does a great job at living up to the versatility name. The VersaChoice 10 is a strong growth annuity with enhanced liquidity features if you choose to have them for that 60 basis point fee. And really a lot to look to, to consider, a lot of value, a lot of benefits and features that address the most common concerns for someone entering retirement or that has been retired. If you're looking for safe interest, if you're looking for an alternative vehicle to traditional safe money investments like bonds or money market accounts, bank CDs, if you're looking for upside potential based on market index performance with zero downside risk, the VersaChoice 10 is definitely an annuity that you should consider. So if you're interested in getting a personalized quote for this product, or maybe even comparing this one to some others that you're contemplating on, you can visit our website at www.annuityassociation.com. And right on the main page, there's a form that you fill out to request your free report. Fill out the questions there after you request that report, answer them to the best of your ability, and we'll get that out to you in a timely fashion. So hope that you've gotten some value out of this annuity review by AnnuityAssociation.com. I'm Jeremiah Conjure signing out. Thanks so much. Have a great day.